All right, let's jump right in this week, Doug. And, you love him or loathe him. Donald Trump's the president of the United States. So I think for our purposes on this podcast, and people don't want to ask dumb questions, what are the questions they're going to ask? How do I make money off this, right? How do I make money off the Trump win? I know in the stock market, you have some ideas with his energy or defense stocks, financial stocks. So give us some ideas. How do we make money off Trump?
Well, the first thing you look at is what is he going to do differently than the current or soon to be previous administration? And what they've done is they've done a lot of regulations in energy and in financials. And they haven't been a great friend to mergers and acquisitions. So I think if you look at that and then compare that to what Trump is going to do as a backdrop, that kind of gives you a clue. There's going to be less regulations in those areas, and therefore you should have some M&A activity pick up, and therefore in the energy space and even in aerospace, of course, because of Trump probably building up defense. Those kinds of things are the first things you want to look at when just comparing and contrasting the two administrations.
Do people get more aggressive or less aggressive, or is that not the right way to look at it? I just think about a normal person who maybe not picking individual stocks all the time. They look at their 401k and they always give you that option to be a more aggressive, less aggressive investor, or rotate in some way, shape, or form. Of course, it all depends on how old you are and all kinds
Sure.
of other different factors. But what about for this administration? More aggressive in the stock market? Is that fair or no?
Well, it's interesting. I did have taking clients as a barometer. There
Yeah.
were some people who, right before the election, due to the uncertainty, which is one of the things that can happen, some people did want to take the pedal off a little bit. But as soon as Trump got in, there were a bunch of clients who said, I think this could be better for business. So they actually ramped up their aggressiveness. And so normally most people, the vast majority, shouldn't change their overall long-term game plan. But some people do trade around the edges. And I think the feeling is we could take clues from the two administrations. We actually have the stock market data on how they've both done. And they've both done really well with double-digit returns.
Right.
But admittedly, Trump has maybe a 3 to 3.5% per year average extra return in the market relative to Biden. But they're both double digits. So I think, if the feeling is we're going to get a little bit more growth, that's some of the people thinking that maybe I could up my risk level. But I would not go crazy because not that much changes between the two.
Yeah, a lot of that's timing too, right? When you come into office, we've talked even on TV when
Yeah.
you're on with me on News Nation about the fact that Trump seems to be coming in at a relatively good time again. I mean, he did in 2017 when he came in the last time the economy was all right. And this time, how would you describe it this time? It's not like, Obama came in during a financial crisis, Biden during a pandemic.
Right.
What about this time?
Yeah, he did come in during some good times, and then the COVID part did disrupt.
Yeah, at the end. Yeah.
Yeah, at the end. But now if that doesn't happen, I mean, we've got different issues now because the debt is so much more than, I mean, the two of them added together, how much they've added. So that's going to weigh on things, and therefore interest rates are higher than they were. Inflation is higher than it was, even though it was very low during Trump's first administration. It's a little bit higher now. So there's slight things you have to do differently. But I think overall, the economy is in good shape. The consumer is in good shape. And so that's going to set the backdrop for some good things. If they do give people more money with continuing the tax credits, allow them to continue to save and invest, and do more that way, then that backdrop is good if the consumer stays in good shape. Because as it is, it's about 70% of our entire economy. And therefore, and we're the biggest economy in the world. So that goes a long way.
I wonder if you ever worry that they could be too friendly to business interests. In other words, not worried about the debt because of the tax cuts, spending more than you should, which the Biden administration certainly, you could argue, did, but so did the previous Trump administration. That was not something that was necessarily a priority in Trump 1.0. Now more deregulation. Some people look back at the Clinton years, and that was a happy time in terms of deregulation. And they say, well, we had the financial crisis years later. I mean, any risk here of going too far with these business friendly and what they think are growth friendly policies, do you think?
I think there's always a risk of that. The issue is we actually just don't know where the line is on either side. How
Right.
much before you choke it off and how much where people are taking unnecessary risks and putting the entire economy in danger because there's no regulations. So there's a line there. I think it could be argued that wherever the middle is and you go one way or the other, they're going to go more to the point of less regulation. Perhaps they do go too far, and then we'll know it when we see it. But until then, there's definitely room there. The biggest thing that I think about is that just thinking about the corporate tax rate differences between what Harris proposed and what Trump is proposing, if he can get it through, was with with Trump lowering the corporate tax rate to 21 and Kamala wanting to raise it back up to 28, where previously it had been in 35.
Right.
Trump now wants to take it down to 15. I don't know if he's going to get it all the way down to 15 from 21. Originally, he said 20 just to get a little bit lower. But if we do get to 15 corporate tax, the interesting thing about that is that just translates into huge extra dollars for the companies in terms of their earnings. And so one of the measures that most people feel the stock market is very overvalued relative to the earnings. And I don't disagree. However, if you drop the corporate tax rate to 15, suddenly that earnings translation of extra money means the price to earnings ratio drops to right in line with normal historical averages. So it turns an overvalued market into a very normal, fairly valued market at 15. At 28%, it would have went the other way. It would have made the companies even more overvalued. So there's that as a backdrop too. And I think that gives some people some ideas that maybe there's more room here if they do get corporate tax rates lower, and then the companies can make more money and that translates into higher earnings. Hopefully it'll translate into lower prices too, but I think they're going to do a combination of the two.
Well, that's a really interesting way, I think a valuable way of explaining it to people. So because you hear, one-liners all the time about, to your point, the stock market being overvalued or, getting a little long in the tooth or something along those lines. But that puts it in a way that you could understand how you could make money, vis-a-vis American companies. In other words, that's how stocks go up, that American companies in this case, and I'm emphasizing American on purpose, are making more profits. Their stocks over the long term or stock prices go up, and there's, it's a more valuable company. And let's talk about that for a minute. The idea of American companies in this administration, that there's definitely a bias towards American. It's like when Trump meets with the Xi Jinping, he says, well, he's for China, I'm for America, that kind of thing. But the policy of that, it could be very real, whether it's tariffs or other policies and trade, that American companies do better than companies that have more of an international footprint in this administration.
It's interesting when people ask me what percentage of their portfolio is international. It's funny because when you look at what percentage your portfolio is international, determining whether a stock is international is where it's domiciled. So wherever the country has its headquarters is what determines whether it is. Now, that foreign country might have 2/3 of their revenue from the United States, but it's still a foreign company, and vice versa. You can have an American company that has the majority of its earnings from overseas.
So not as many Irish accents in some of these tech companies as you would expect based on.
True. There were a lot of those during the Clinton administration.
Yeah, remember that?
By the way, that was
they were charging. So speaking of corporate taxes, the Irish had a good deal going there. That's right.
Exactly.
Come on over.
Yeah, come on. But the one thing you can do is, like, I use Walmart as a barometer. If you look at Walmart, the largest retailer in the US, their revenue, and you can look this up, and this is what the kind of thing you want to do with your portfolio. Some of the stocks I own, what percentage of the revenue of the company I own is domestic, is US based? Walmart is 68.2 as of now. So that's my starting point. What we're looking for.
But how does that compare to other big companies? Like, what's a normal number?
So that in an international conglomerate such as Walmart and these other companies, that's why I use that as a barometer. Where is that relative? Because we think of it as a large U.S. retailer, but they do have an overseas footprint. So I think it's sort of the baseline for me. What I'm looking for then are companies that have a higher percentage of that. If you believe that there's going to be a lot of onshoring because they're going to tariff the foreign countries, and then these companies are going to figure out, hey, it's better to invest in the U.S. and hire U.S. workers and make the products here, and in the end, that'll do more than just offset offset the tariffs,
Right.
then companies that have a higher percentage of U.S. are going to do better, which is
So higher
interesting.
than 68%. You start, that's what your rule of
Correct.
thumb is. You start with
That's a good
Walmart,
rule of thumb.
anybody. Yeah, are a lot of companies higher than that? I guess it
So
depends. Yeah.
here's how it breaks down. On the
Okay.
large companies, if you're an international conglomerate, that's a good barometer. When you're getting to smaller companies, what's really interesting, most of the small companies or small cap stocks, if you will, are much higher because they're small and they're basically US based. And so that's
Right.
another argument for in small cap stocks and smaller companies doing well. So higher M&A activity, which those small companies get gobbled up by other ones, higher U.S. Presence in terms of their profits and revenue. So those things play into where they can do better than some of those larger international companies and certainly foreign countries who have the majority of their revenue overseas if they're going to have a tariff issue.
So, but is that generally a bet that you'd be making, in this administration? I know they're going to talk about it and they're going to try to do it, but this idea of onshoring
Mm-hmm.
becoming a reality, is that's a fair bet, you think, in general, to make, or to be kind of biased towards in your outlook if you're looking to have an angle here?
I definitely think so because
Yeah.
you're going to have a short-term negative from the impact of tariffs. You're
Right.
going to get a little hit to GDP. You're going to have inflation be a little higher. It might only be a third of a point higher, but whatever it is, it's going to be meaningful to a degree when you look at it. So when you stretch it out, if these companies do bring this, and this actually happened in Trump 1.0, where the companies flooded back and onshored. And so then it kicks in and it has a longer term impact. So if you think about investing in the short term, you might see playing to the, oh, look, we're having a higher GDP and higher inflation. But when you stretch it out and go longer view, and what are you investing for, especially with your 401k money, 10, 15, 20 years?
Sure.
That's a good bet for the long run. In the short run, it might work a little against you, but investing is looking through that for the long term and picking your opportunities. And so with that volatility, there might be some opportunities at these highs when things come off a bit to pick up some of these investments that kind of got away from you with the recent run after the election and how the market has done this year overall.
I guess, to play devil's advocate, the flip side that I would think of that, and tell me what you think of that. If a company, company A is doing a lot of business overseas and they've obviously cut their costs, it's the reason they went there to begin with. Now they're going to come back on because of these incentives that Trump and company have provided. They're going to come back on shore because, he's made it prohibitive to be overseas. Their cost structure, in terms of, yes, it's going to be maybe better for them than doing it overseas, but their costs are still probably going to go up because they're going to have to pay U.S. workers to do their money.
Yes.
And then I just wonder about profitability kind of in this new environment for some of those companies. Like, to me, it would be challenging either way, right? Like, whether you're overseas and you have to pay a ridiculous tariff, or if you're, or you get hit with a ridiculous tariff that somebody has to pay, and then, or you're coming back and your costs they're still going up, right?
They're going to go up. That's to your point. That's exactly the reason they brought it offshore in the first place, because there was a savings. But let's say it was a 20% savings, and now you're going to hit with a 10% tariff, and you're like, I don't know if it still makes sense. I think part of this,
that's nothing. Trump said 100% tariffs. So maybe, maybe I'm listening too closely.
He gets through. I don't know. I mean, we do have now a GOP, full Congress, and so that changes the dynamic of getting.
But you
things
think
through.
The numbers work in the company's favor still to be profitable in some cases, or will work to come back on shore?
I think it's going to be, if you call it a net zero or maybe slightly negative, the national security aspects and the overall longer term nature of the U.S. itself is kind of what you're playing against. Obviously, if it's still cheaper to keep it overseas, they're going to keep it overseas. But if it's sort of within the margin of error or a few percentage points, that's what you want. You want to, even if it costs a little bit more, they'll eat that in the long run. That's better off for the overall country. I think that's part of what's at play here.
That makes sense. Now, you mentioned Congress, and I do think we should spend a few minutes on that, because right here we'll have to live up to the name of our podcast of No Dumb Questions, because this might be a dumb question, because if you're listening to this very podcast pre-election, we were telling you gridlock is good. And, if there's a split in the Congress between the White House goes one way, Congress goes the other, that's probably better, as traditionally has been the case for investors. But now we don't have gridlock. So is no gridlock potentially good too? I mean, is that one of the risks of this Trump administration, or can the Republicans get their act together and actually make this a pro-growth environment, which they always talk about, but don't always deliver? I mean, the stock
Right.
market, again, can't say this enough. Stock market goes up no matter who the hell's president or who's in the Congress over the long term. But all GOP has actually been probably the worst of all the combinations for whatever reason. And some of that could be just bad luck or timing. I don't know.
Yeah, I think the absolute worst is Republican president, both houses, Democrat. But
Democrat, okay. But
yeah, but right behind that is Republican president and all Republican
well,
Congress.
right, which you wouldn't, which if you just do nothing, you would say, "Oh, it doesn't, they're pro-business." You would think they would do a better
You
job. But,
would.
and again, some of this might be the timing and when they came in, but that's what we're dealing with here again. So risk or no?
Yeah, there's no doubt that in either party being president, when you have the opposite, when you have divided Congress, that is the absolute best combination. That remains the best combination.
Yeah.
And so there is a risk. And I think it's in either party. If the Democrats would have won and fully swept that way, what happens is they both tend to go too far. And so while in the beginning there's a lot of positives, if they get so much through that it balloons the deficit and
right, you want to go back to getting nothing done, which you said before. They promise everything. They get about 5% of what they promised done, which I know you had a study you looked up, and that it sounds crazy, but it's probably about right. But God forbid, don't be getting 10 or 15% of what you promised done. We don't want that.
Well, the highest percentages ever were 8%. So I'm pretty sure
isn't that
that
crazy.
It is crazy. And so this is the risk. If Trump comes through and gets more than 8%, if he gets 10%, all of a sudden you're getting to the point where you could hit those extremes because it's more than any other president has ever gotten
right.
through.
Yeah, we can't have a president coming in and getting 10% of what they promised accomplished. I mean, what kind of country is this? But it's true.
Exactly. But the biggest benefit though is that the elections that come up in 2 years, and this is what happens in every president who has both sides of Congress, it tends to go the other way in 2 years. And then they don't really get through everything they wanted to get through in the first 2 years while they had everything. So we'll see how it plays out. But in the short run, there's a lot of things they can get through just in terms of deregulation and all of that.
Well, they'll be able to extend the tax cuts, don't you think, which would be a big thing? I mean, they should be able to get I would be shocked if Republicans, and they have enough control, wouldn't support that.
Yes, and they're going to offset the cost of that with some ways that they can maneuver the calculations, and then also with the tariffs and the calculations. But yes, I think that, look, there's no doubt that the people in the middle part of the income spectrum, their tax brackets went down and their standard deduction went way up. And about 90% of the people now file with the standard deduction, where before that it was far less because it made sense to itemize. So that would have been the other way. They would have had to do some things had they let these things expire at the end of next year. So
Can you maybe stop and explain? I think
Sure.
it's probably worth stopping and explaining there for people, especially since we're supposed to be focused on financial literacy. And I'll ask the dumb questions this time around. No dumb questions, but I'll ask them about standard deduction versus itemizing and what you see changing this time. What is it? And what will be different?
So when the standard deduction for a couple or an individual person was set at a few $1,000s, if you had deductible expenses that totaled more than the standard, you would quote unquote itemize. You would detail all of your deductions, your charity and all the other things that you would do. And if that was more, you would take the itemized deduction. And in the interest of simplifying everything and changing the tax brackets, making them lower, they raised the standard deduction to more than double what it had been. So what happened is there was a whole bunch of people that formerly were detailing them and itemizing that were like, I still don't come up to the new automatic deduction I get off my income, so I just take that. And so a lot of people, their tax life got much simpler by taking the standard deduction. There were other problems, like now you couldn't itemize your charity, and so some charitable issues happened. But at the end of the day, people ended up with more money, whether they believe it or not. The net result was they ended up paying less in taxes. And so the extension of that allows for the higher standard deduction. More people continue in the current path, where if they would have done the math now versus the previous one, they likely would have paid more in tax at the middle part. And so, and those are the people that need it. because everything has gotten so much more expensive in terms of inflation, and so keeping that money in their pocket keeps the consumer going. And I think that's really one of the big benefits to extending the tax cuts. Now, that also means that you may have a deficit issue, but the only way to get out of that is if we can really grow the economy even greater than it has been. The 20-year average GDP number is like 2.1%. And that seems awfully low considering how much government
Yep.
has grown and everything. So the big backdrop of this is smaller government, get out of the way, get the growth numbers up. That is really the recipe for kind of getting the deficits under control and possibly getting to a point where you can get them to shrink. Wouldn't that be amazing if we
Yeah,
could
that
move them?
would be that would be retro. That would be retro, going back to I guess the late '90s, early,
Clinton.
right,
Yeah.
right when we had the balanced budget. Let's talk a little bit. We talked already so much about stocks. We talked now about taxes. We've gone through different sectors that may or may not benefit. Let's talk a little bit about the bond market, I think, before
Sure.
we go. It doesn't get enough attention for being the largest of the markets here that people should be worried about, and interest rates are a big factor there. So is there an outlook for bonds in terms of what Trump means for bonds versus what he means for stocks?
Yeah. So with the short-term potential bump up in inflation, that means interest rates will remain higher for a little bit longer. They're still going to come down in the short run, in the shorter term parts of the yield curve, if you will. And that just means that the shorter term bonds are paying virtually the same as the longer term bonds. Now, longer term bonds are higher, which is translated into higher mortgage rates. Trump definitely wants to get that down, but the Fed really only controls the shorter term rate part. And even though they've lowered interest rates, the interest rates have not gotten lower. They've actually gone up because of the anticipation of the higher rates. So if you think that in the short run, that's going to be a little bit higher inflation because of the policies, then interest rates will stay higher a little bit longer. But then as that sort of dissipates, you should get the lowering of interest rates eventually that you would expect. It may not just happen in the first 6 to 12 months, but longer term, you still do expect that to come more in line with where things are. So the way to play that is you're really not getting paid to go out 10 or 20 years
Right.
versus staying, 1 or 2 years on the yield curve. So what that means is you can stay shorter term. That's a safer way to play it. And then the risk is that when rates come down, you can't reinvest that when it comes due. But that's not really what you're seeing right now on the government and taxable side. On the
All right.
municipal, yeah, just one last thing on the municipal side for those in a higher tax bracket. Tax-free bonds actually have a very normal yield curve where you are paid to go out longer term. So if you see some yields you like, it does make sense to lock those in. The after-tax effective yield on that is quite high, and taking advantage of that is a really good opportunity right now.
All right. That might be I think the least hyperbolic 20 minutes or so conversation about Donald Trump that anybody's ever had. So I hope we help some people. You got to, this is what's going on. This is the reality. And now you got to adjust your life and your investments accordingly. I think Doug was helpful in that, right? So, I mean, overall, it seems like you're relatively optimistic about things for the economy. Is that fair? I mean, I know we have, like
Yeah,
you said earlier, we have some challenges, but you're relatively
definitely.
optimistic here,
I
right?
mean, to me, it's like the backdrop is a better environment.
Right.
How far it goes and how far they take it is always the risk there, right? So yes, I think optimism is out there. You can see that in the sentiment and the markets, and people are feeling like it's going to be better. And then things will kind of settle in there and anticipate it. And then it has to come to action. That's what the market's doing, is anticipating it. Now it actually has to happen. So we'll see how it goes with the current administration and the current Congress.
We'll talk about it on News Nation, my show that's on from 3 to 5 p.m. News Nation Now. Doug's on 3 times a week, basically usually right before the
Yes.
closing bell, which is 4 p.m. Eastern time, so a little bit before that and leading up to the bell. So we'll talk about these issues there, and we'll have a longer form discussion here on our No Dumb Questions podcast. And, we promised we'd get in, and we are. This is all about financial literacy, but I think we'll dig in the next few weeks to some of these bigger picture topics that can help people with their financial literacy. So we look forward to doing that. If you're watching the video version of our podcast, see, I do have my swag on from Decision Desk HQ today. That was the firm that we use at News Nation that helped us call the election way before everyone else. So Doug could go to sleep relatively early on election
That was
night.
fantastic.
When they were
by
they're
2
great.
o'clock,
Yeah, these guys, Scott Tranter and these guys at Decision Desk HQ, they do an awesome job. So thanks for watching or for listening here on No Dumb Questions. For Doug Flynn, I'm Connell McShane. This is episode 4. We'll see you on episode 5.